Welcome back to our channel. Today we're breaking down one of the most important concepts in the world of finance, the federal funds rate. What is it? Why does it matter? And how does it affect you as an individual or investor? Stick around to find out. The federal funds rate is the interest rate at which banks lend reserve balances to other depository institutions overnight. It's a crucial part of monetary policy in the United States and serves as a benchmark for other interest rates in the economy. To put it simply, when banks have excess reserves, they lend them to other banks that need to meet their reserve requirements. The rate they charge for these loans is the federal funds rate. The Federal Reserve, often referred to as the Fed, is responsible for setting the target range for the federal funds rate. The Fed meets regularly, typically 8 times a year, to evaluate economic conditions and make decisions about interest rates. The Fed uses a range of economic indicators, including inflation, employment rates, and GDP growth, to guide their decisions. If the economy is growing too quickly and inflation is rising, the Fed may increase the rate to cool things down. Conversely, if the economy is sluggish, they might lower the rate to encourage borrowing and spending. The federal funds rate has a ripple effect throughout the economy. When the rate rises, borrowing costs for consumers and businesses also increase. This can lead to reduced spending and investment, slowing down economic growth. On the flip side, when the Fed lowers the rate, it makes borrowing cheaper. This typically encourages spending and investment, which can stimulate economic growth. It's a delicate balancing act. So how does the federal funds rate affect you personally? The answer lies in various financial products you use every day. Mortgage rates. When the Fed raises the federal funds rate, mortgage rates usually follow suit. This means higher monthly payments for new homeowners. Credit cards. Many credit card interest rates are tied to the Fed funds rate. When it goes up, so do your interest charges if you carry a balance. Savings accounts. On the other hand, if rates rise, banks may increase the interest rates on savings accounts, which can benefit savers. Let's take a look at some historical trends of the federal funds rate. Since its establishment, the rate has experienced significant fluctuations based on the economic climate. For example, during the late 1970s and early 1980s, the rate skyrocketed to combat hyperinflation, peaking at over 20%. This had a profound impact on borrowing and spending in the economy. The federal funds rate plays a crucial role during economic crises. In response to the 2008 financial crisis, the Fed slashed rates to near zero in an effort to stimulate the economy. Similarly, during the COVID-19 pandemic, the Fed quickly lowered the rate to support the economy. These actions demonstrate the Fed's pivotal role in managing economic downturns. As of now, the federal funds rate has been the subject of much discussion among economists and investors. The Fed has indicated its intention to combat inflation, which has been a growing concern in recent months. It's essential to stay informed about the Fed's actions, as changes in the federal funds rate can signal shifts in the economy that affect you. So how can you navigate changes in the federal funds rate? Here are a few tips. 1. Stay informed. Follow news and updates regarding Federal Reserve meetings and economic forecasts. 2. Consider fixed versus variable rates. If you're looking to borrow, consider whether a fixed or variable interest rate is better for your financial situation. 3. Review your budget. Adjust your budget to accommodate potential increases in borrowing costs. There are some common misconceptions about the federal funds rate that we should clear up. First, it's not the rate consumers pay. Many people think the federal funds rate is what they pay for loans, but it's actually an interbank rate. Second, it doesn't directly control all rates. While it influences many interest rates, not every financial product is directly tied to the federal funds rate. The federal funds rate doesn't just impact the US economy, it has global repercussions. As the world's largest economy, changes in US interest rates can affect currencies, foreign investments, and global trade. For instance, when the Fed raises rates, it can strengthen the US dollar, impacting trade balance. Understanding the federal funds rate is crucial for anyone looking to navigate the financial landscape. It influences your loans, savings, and even the broader economy. What do you think about the federal funds rate? How do you think it will affect you in the coming months? Let us know in the comments below. If you found this video helpful, don't forget to like, share, and subscribe for more insights into finance and economics. Until next time, stay informed and make smart financial decisions.